the mechanics of trading options. Before going into the details, secrets, tips, and techniques of options trading, we have to first get you used to the terminology used in the industry. An option is a contract to buy or sell an underlying instrument or underlying interest. Owning stock options is different from owning the actual shares of the stock. When you own an option, you have the right, but not the obligation, to control the stock at a specified price, called strike price, until a specified time called expiration date. If the option is not exercised before the expiration date, it will expire worthless. There are two types of options: call options and put options. Call options give the owner the right to buy the underlying asset stock at the specified price before the expiration date. Put options give the owner the right to sell the underlying asset stock at the specified price before the expiration date. Note, don't worry about understanding all of these at once. You will learn sooner than you think, and in a short period of time, you'll be able to explain the mechanics to others by yourself. The strike price, or the exercise price, is the price at which the underlying asset may be purchased or sold. You'll see stock option prices listed in increments of 50 cents, $1, $2.50, $5, or $10, depending on the underlying stock price at the time. The expiration date is the date when the stock option expires. The third Friday of every month is the last day for trading that stock option before it expires, unless that third Friday is a market holiday, which makes the expiration on Thursday night before the Friday. Regardless, the actual expiration of the option contract is always the Saturday following the third Friday of the month. All listed options can be traded with at least 4 expiration dates. There are also stocks and indices with options trading out as far as 2 years. Those are called leaps. There are also 2 definitions of options premium. One refers to the price of the option, and then 2, most used by professional traders, is the time, the intrinsic value. Either way, an options premium is determined by many factors, including the stock price, the strike price of the option, the time left before the option expiration, interest rates, dividends, and the volatility. One option contract represents 100 shares of the underlying stock. Example: stock is $5. Premium received or paid for one contract is $500. When you sell an option, you get the premium credited into your trading account. When you buy an option, your account is debited the premium you've paid for the option. When trading options, you are able to control more shares of the underlying stock with relatively less money. This will allow you to have larger gains even when the stock does not make big moves. If traded correctly and in a timely manner, you may earn double and triple-digit returns on your capital. In addition, when buying an option contract, your maximum loss may be the amount you've paid when purchasing the option. As you can see, when trading options the right way, you can limit your loss and maximize your gains in any market, anytime, on any stock traded in the market. Trading stocks and options in volatile markets can be very rewarding. In addition, it may provide a security if you have long-term investment positions. Chance to buy the stocks you like at a lower price to maximize your profits. Generate passive income on already existing long or short positions. Every time market volatility moves, the stock moves up or down, you make a profit. The key to being a successful trader is having the right knowledge and skills and executing them in a timely manner. We would like to thank you for taking the time to watch the videos that we have put together for you today. Take a look and subscribe to our YouTube channel, our Instagram, our Facebook page, and reach out if you have additional questions. We would love to hear from you. Check out our website for more information. Go to www.optiontradersnetwork.com. Thanks so much.